Today's video looks at an interesting question that I received from Richard, who is in the position of leaving South Africa, moving to Singapore for a 3 to 5 year contract. And he wants to know whether he should sell his property and rather invest the money or keep the property in case when he comes back to South Africa, he wants to live in it again. So I think this is quite an interesting scenario. I've got my financial models. I've got some interesting data that we're going to look at. So the entire purpose of this video is to compare the trade-offs between selling the property on the one side, which would obviously attract estate agent fees and tax, and then investing that, or holding on to the property, renting it out and investing the rental proceeds in the stock market. So we've got some interesting comparisons to do. First, some background is that Richard is a South African. He's been offered a 3 to 5 year contract to work in Singapore, and he owns a home in Constantia Hills, which is currently valued at 11 million rand. And is worried about the maintenance and the management of the property since he's going to be out of the country. He also mentioned that for a similar property like this in the area, the rental income is expected to be 65,000 rand a month. Before we look at the numbers, if you want to submit your question, you can follow the link in the caption. I try to answer questions that would be interesting to the audience, but also that have as much detail as possible. And also, if you don't know yet, I have a weekly newsletter that I send on every Friday. And if you haven't joined that yet, you need to sign up. The link is in the caption. It's completely free. And I usually just share personal insights on my money matters or what's happening in the stock market or what I've learned. It's definitely worth reading every Friday. So let's look at the numbers. On the sheet, you'll see I look at one side selling the property, and we're assuming it would be sold at 11 million rand. It would attract an estate agent fee of 5%. So after paying the estate agent, he would be left with 10.45 million. Then I just made some assumptions on the cost because I want to calculate the potential capital gains tax that will be payable. So I assumed he paid 6 million for the property and they made renovations or additions of 1.5 million, which would mean the base cost of this property is 7.5 million. This is relevant for calculating a gain for capital gains tax. He would qualify for a primary residence exclusion. Again, I'm assuming he holds this in his personal capacity where he would qualify for this, and also assuming that he's lived in this property since he's purchased it himself. So the inclusion rate for this capital gain is 40% into your taxable income. And I'm assuming his personal income tax rate, this would be included at the highest marginal bracket of 45%. Again, that's an assumption. Unfortunately, he didn't share his payslip with me, so I don't have all of his salary data. Maybe that's like sharing too much info, although I wouldn't mind all the details, to be honest. I then calculated that the capital gains tax payable based on these inputs would be 171,000 capital gains tax payable. This is obviously not a big amount of capital gains tax payable. This is purely because of this primary residence exclusion that he would qualify for if he holds a property in his personal name. So then the proceeds after the estate agent fees and taxes paid would be 10.2 million. Now I'm looking at what his portfolio could potentially be worth if he invested that 10.2 million. So the return assumption I'm using is I'm assuming that he would invest this money in a globally diversified ETF, like for example, this MSCI World Index ETF, which in Rand has returned 13% since April 2008, since its inception. But I'm going to make an assumption on dividend tax on this return so that we can have a return net of dividend tax. The return I'm using is 11.96%, and that is an annual average return. Of course, this is past returns and we have no guarantee it will continue to give these returns in future, but you have to make some assumptions to be able to forecast. So we're assuming he's holding this for a 5-year period. I'm going to talk about whether it's prudent to hold an investment for only a 5-year timeline. But let's just assume that's going to happen and we're going to get these returns. The value of the investment would be 18 million after 5 years, assuming that he's invested the money after paying the estate agent fee and after paying capital gains tax. Then also assuming he's going to sell this investment, because then let's say he moves back after 5 years, now he wants to buy another property, then he would have to pay capital gains tax again. So the value of the investment after 5 years is 18 million. But now we're assuming that he moves back to South Africa and he wants to sell off this investment to buy another property. That would, of course, attract capital gains tax too. In this case, it would be very dependent on where he is a tax resident at the time. But if his intention is to move back to South Africa, he would likely remain a tax resident in South Africa. So he probably will have to pay capital gains tax on the sale of this stock portfolio. After paying capital gains tax, he would be left with 16.6 million. Now let's look at holding onto the property and what that could look like. So again, he said he'll probably get around 65,000 rand a month rental income. On an annual basis, that's 780,000. Then I'm assuming there will be annual costs of 1% for repairs and maintenance, 1% of the property value, which is 110,000 a year. And this is obviously very dependent on how old or new the property is, what kind of changes they would have to make, what kind of tenants they have in there, and if they actually look after the place or whether they need to fix things when, for example, there's a new tenant coming in. Then I included rates, taxes, and insurance assumption for 125,000 Rand per year. This is again dependent on where the property exactly is located and whether it's in an estate or not and what the levies are like there. So this is also just kind of a rough assumption to include. And a rental agent. I'm assuming he's going to use a rental agent because he said that he was worried about the management of the property when he is abroad. And it's very hard to manage a property when you're outside South Africa, so far away from it. Tenants have issues, or they're moving out and you need to find a replacement. So in this case, he will probably need a rental agent, and I'm assuming that they'll take 5% of the rental income. After paying all of these costs, he would be left with 506,000 a year. Then I'm assuming that since he is out of South Africa, his personal income tax rate would be lower. Also, since he would probably qualify for an exemption on the foreign income that he earns, I'm just assuming that his personal income tax rate would be 36% when he's out of the country, and that this income from the property will be taxed at 36%. This is something that a lot of people forget about, is when they do calculations on trade-offs on properties, they forget that if there's a profit on the property, it will actually be taxable. So it's important to exclude the tax amount if you want to make a fair comparison. So let's say this rental income is going to increase with 6% per year, which is just slightly above inflation. And we're also going to assume that this rental income amount after tax is going to be invested in the stock market. So in this case, as you can see here, the rental income increases every year from year 1 from 323,000 to year 5 to 408,000. And again, we're saying it's being invested in the stock market and it's earning the same return, the 11.96% after dividends tax of the MSCI World ETF that I mentioned earlier. Again, this is just an assumption I'm using to be able to do some forecasting. There is no guarantee on this outcome. After 5 years, the stock portfolio that's been built up from the rental income would be worth 2.5 million. And of course, he would still own the property. So let's look at what the value of the property could be. I looked at 14 years of data on properties in the city of Cape Town, and the average annual increase on residential property has been 6% per year over these 14 years. So I'm going to assume that this property's value increases with 6% per year. This is obviously quite a bit above the average in South Africa and much higher than any other city in South Africa in terms of the annual increases in property value. So in this case, the value of the property is assumed to go from 11 million to 14.7 million after 5 years. And that's because of the 6% per year increase in the value. So the total investments that he would build up on the side of keeping the property, the total of that would be 17.2 million. In this case, we're assuming he's moving back to South Africa and moving back into the property again. So there's no sale on the property. And also we're assuming he's not selling the stock market portfolio. So it wouldn't attract any capital gains tax since no sale takes place. Therefore, if the stock market performs according to these assumptions, on the one side by selling the property, paying the agent and the capital gains tax, he could potentially sit with 16.6 million. On the other side, taking the rental profits after deducting all of the costs related to the rental, investing that for 5 years, and then keeping the property, he could potentially sit with a total value of 17.2 million. These scenarios are actually quite comparable. And on the one side, it's a little bit higher keeping the property. But something that's way more important to consider is whether a 5-year timeline is long enough to take this kind of risk. To sell off a property that you potentially want to move back into, or that you might need a property again in 5 years' time. So that's something that I want us to look at next. If you're finding this video interesting so far, remember to sign up to my weekly newsletter. It's free, it's interesting, it's short and simple, straight to your email. Sign up using the link in the caption. So is a 5-year period too short to sell your property, invest in the stock market, and then potentially move back and sell off your shares again? So here's a chart that looks at the risk of losing your money based on different timelines. This looks at stock market data since 1926. It then determines if you invest in the stock market and you only hold your money, for example, for a month, then you have a 62% chance of getting more money out than what you put in. And this, of course, again, is based on historic data. There's no guarantee that this will happen in future. For a 1-year timeline, 75% chance. Over a 5-year timeline, an 89% chance. Over 10 years, it increases to 95%, and over 15 years, 99.8%. So this calculation would obviously depend on so many factors and so many assumptions, but especially whether Richard in this case has a high risk appetite and whether he is okay with investing the money for 5 years and potentially getting less money out than what he put in. And I'm not about fear mongering. So I think people might look at this now and say, oh, but I have a chance of getting less money out. It's very good to be aware of the risks, because there is always a chance that the stock market is going to go down, especially if you look at a shorter timeline. But as you can see, if you stretch it out to 15 years, there is only a 0.2% chance of you losing money over a 15-year period. And we also need to consider the upsides of investing in the stock market, because stock market investing is volatile. But because of this volatility, which means higher risk, we also expect higher returns. So have a look at this infographic. And I think it's interesting to show that over a 1 year, 5 year, 10 year, and 20 year period, what the range of returns was on stocks, bonds, and a mixed portfolio. So I'm just going to focus on the stocks for now, because that's the assumption I used in this video. And I assumed that he would put 100% of the proceeds into the stock market. Of course, that can also be a split. Again, this is historic data between 1950 and 2018. Historic data, no guarantee it's going to look like this in future. Over a 1 year period, the worst year was 39% down, and the best year was 47% up. The worst 5 years was 3% down or 28% up. By the way, this is an annual average return, so it's not a cumulative amount over 5 years. That's 28% per year. But that's the best case scenario based on the historic returns. The worst case would have been negative 3% on average per year. Over a 10-year period, it was 19% per year, best case 10 years. And worst case 10 years, negative 1% per year. So I think this is good to just give you some perspective on this. Is yes, that of course there is risk of losing money over a 5-year timeline, but over a 5-year timeline, the risk of losing money on the historic returns would have been negative 3% per year. And the best case scenario would have been 28% per year. But of course, these are two outlier possibilities. The real picture, or what's going to happen in reality, is obviously going to be somewhere in between, or it might actually be even worse or even better. There's no way to tell. I think it's just interesting to be aware of the potential outcomes or what's happened in the past, and to make some data-driven or informed decisions. So what would I do personally? Personally, if it's only a 5-year timeline, I would not take the risk of selling the property and investing that money. And this is just because I know it's so hard to find another property again, unless Richard in this case is sure that when he moves back to South Africa, well, first of all, is there a chance that he might not move back and stay in Singapore for longer? Second of all, if he moves back and he's likely going to want to live in a smaller or bigger property, depending on family circumstances, then I would probably say selling is a good choice, since you're going to have to sell it anyway, because managing a property while you've got a full-time job out of the country is really not an easy or pleasant task. But if they love the house, it's close to good schools, they know how hard it is to get a house in that area for a decent price, and they're scared that when they move back, if it's a certainty that they won't find something like it again easily, then I would not sell the property. I would hold it, make sure I get good tenants in, a good agent to manage it for me, and I would make sure to invest the proceeds that I get into the stock market to give me that some diversification and long-term growth. Let me know your thoughts, what else you would think of if you were in his position, and also whether you would sell the property and invest money, or rather keep the property. Let me know what you think in the comments. See you next time.